Hello everybody, I'm Sergio Mariaca and welcome to the fourth quarter market review where I will review the most recent quarter performance for U.S. and international equities. I'll dig into various asset class performance including commercial real estate and fixed income. I'll also review how various diversified portfolios perform. And because this is the last quarter of 2020 and what a year it was, I'm going to focus on annual and longer term performance as well. And just like all my other videos, I'm going to highlight some of the time-tested key principles around investing because if there ever was a year where these principles were important, 2020 was it. Now, before I get started, I'm going to be reviewing historical performance, and I need you to know that past performance is never a guarantee of future results. Next, everyone's situation is different, and this information is for general purposes only. It does not constitute investment advice or a recommendation of any kind. So I think everyone is happy to see 2020 in the rearview mirror, and as we go into 2021, despite all of the challenges of the last 11 or so months, our economy and the markets have been fairly resilient. And I believe we have reasons to be optimistic for an improving economic picture in 2021. So even as the pandemic continues to rage with new cases spiking, pushing governments to enforce restrictions and even new lockdown measures, we now have 3 effective vaccines being administered around the globe, 2 in the United States, and more expected to be approved in the first quarter. And as vaccinations reach a critical mass here in the U.S., sometime likely in the second half of the year, it's anticipated that our lives will begin to normalize and the economic recovery will accelerate and broaden to businesses that have been most impacted, like restaurants and movie theaters and gyms, the travel industry, and more. Next, we remain in a low inflation environment, and we expect the Fed and global central banks to keep interest rates at the current low levels for the foreseeable future, which favors assets like equities. I also think there are some structural changes brought about by the pandemic that are here to stay. Most notably, the pandemic forced the world to take a quantum leap in the adoption of new technologies and the digitalization of our businesses, changing how we work and communicate in profound ways. The most obvious trend is the adoption of remote work, which provides a whole host of benefits, including the ability for organizations to attract and retain talent that live or want to move outside of the company's locality. Organizations are also reporting improved productivity, lower overhead costs, increased job satisfaction, and a better work-life balance for many employees. And because so many are working from home and we even have children going to school from home, the demand for and penetration of broadband internet throughout all communities will most certainly improve a whole host of social and economic issues which correlate positively with GDP growth. So as devastating as this pandemic has been and continues to be, there are a few silver linings in how we have adapted, and I expect as life slowly returns to normal, we may enjoy some long-term benefits as a result. Okay, let's go ahead and get started. So we are looking at the world stock market mountain graph for 2020. I'm actually going to give you some data about the Russell 3000, which is a broad benchmark. The U.S. market kind of looks like this as well. In any event, as we go into 2020, you may remember 2019 was a good year, so we were very optimistic about 2020. We started hearing about this COVID virus out of China. We didn't think much of it. The market didn't think much of it. We know that because on February 2nd, the Dow hits 29,500. And just about 2 weeks later, the pandemic hits us hard. We start talking about restrictions, lockdowns. Europe's going through lockdowns. New York's having some major issues. And investors just abandon stocks. The market, the Russell 3000, in that environment loses 34%. Why? Well, because the media scares everybody to death and they think they're going to lose all their money and this market's going to keep on going down forever, which it never does. This always happens, very predictable. And so the problem is if you abandon your stocks and you didn't get back in, you missed out on this really nice recovery. I'm hoping you didn't do that, and I'm hoping you got back in soon enough. The second quarter was actually the best quarter on record for U.S. Equities. While the first quarter was down 21% for the Russell, second quarter was up 22%. The third quarter, which ends right there, was up about 9.68%. And then the fourth quarter was up 14.6%. So hopefully you stayed disciplined, you stayed in your seats, you didn't let your emotions get the best of you, you looked past the headlines and you allowed the markets to work for you over the long term. And if you are a really good, savvy investor, you were buying into this pullback that's called rebalancing because you had some stable assets. You were diversified. You had stable assets in your portfolio. And so that's how you would have taken advantage of that. All right, let's go ahead and look at the fourth quarter. Now, quarterly performance really doesn't mean much, but it's always nice to see when everything is green and pointing up. Just like the third quarter, the fourth quarter, everything performed very well. Best place to be was emerging markets, which is always nice to see. We also had in 2020, when we look at average quarterly returns, we had a couple of record breakers. On the plus side, we had the best quarter in the recovery, 22% in that second quarter of 2020. And then we had the worst quarter in international developed, down 23.3% in the first quarter. All the previous records for worst performer all still stay back in 2008, the beginning of the financial crisis. And oftentimes when we see best performing or worst performing quarters rather, they're followed within a quarter or two or three, sometimes three, by the best quarter. And that's what we see. And that's what we used to see before 2020 across the board here. The worst quarters were 2008. The best quarters were a subsequent quarter in 2009. All right, let's go ahead and look at some longer term performance. And friends, if you remember, I'm working on a 75-inch smartboard. It has a glass surface that I write on. So when I write, you're going to hear a tapping sound. I apologize for that. All right, so over the last year, look at U.S. equities. I mean, if you would have told me that in the same year that the market pulled back 34%, between February and March, it was going to finish that same calendar year up 21%. That would have been hard to believe, but it happened, and we've seen it before. International developed 7.5% for the year. Look at this, second best place to be, emerging markets. Commercial real estate, this is global commercial real estate, not a surprise. One of the industries most impacted by the pandemic. Why? Because lots of businesses, unfortunately, had to shut down or cannot operate in this environment around the globe. And so people are not paying their rent to their landlords. We've also had lots of companies go out of business, and of course they're not paying. And then for about a third of the workers in the United States, they continue to work from home. So we've even seen companies send all their workforce home, and then they just shut down their traditional office space. And that might be a trend that continues as things normalize. So it might be a longer recovery for commercial real estate. We'll keep an eye on that. Now, 5 and 10 years, I call that the investment zone. Anything less than that is speculation to a sense, certainly 1 year and certainly quarters. But over the last 5 years, U.S. equities, 15.5%, fantastic. International developed 7.6, pretty good. The emerging markets really starting to recover. Longer term, International, developed, and emerging markets still struggling, never really engaged, that recovery never really engaged after the financial crisis, like real estate and like U.S. equities. And then global real estate over the last 5 years being pulled down, dragged down by that, but over a 10-year period looking good. And then look at this number. U.S. equities over the last 10 years, almost 14%. We're used to seeing over longer historical periods about 11%. I think the reason why it's doing better is because the U.S. bond market, and these are generally very safe, high quality, stable bonds, they're paying just a little bit over the inflation rate. And so I think that makes a lot of investors start looking for higher expected return. And so they're moving assets that maybe they shouldn't, but they're moving assets into risk assets, and that's enhancing equity returns. Let's look at world asset classes. I just really want to point out this idea about rotation. We've talked about it before. We see it in the quilt map. If you remember, that's the map that shows all the different asset classes. It looks very random as they go from one year to the next. And so probably one of the worst places you could have been last quarter was Russell 2000. It's now the best place. In fact, last quarter, the Russell 2000 value was up. This is the third quarter, 256. So you might have seen that and you might have said, you know what, I don't need that in my portfolio anymore. Let's get rid of it. And you would have missed this subsequent monster performance. At the same time, the S&P 500, that was number 6. So that was somewhere around here last time. It's now the worst performing asset class, asset index. I certainly would not advise getting rid of that in your portfolio because it will certainly recover and rotate in the future. Here we're just ranking developed and emerging markets. My main point here is the U.S. market is down over here, had a pretty good quarter, but you've got all these other investment opportunities around the globe that outperform U.S. markets. On the emerging side, you have all of these opportunities which outperform U.S. markets, and we see that in longer periods as well. The U.S. is seldom the best performing market, and we know that over longer periods of time, having some global exposure enhances yield and even lowers volatility and risk. So avoid that home country bias because it doesn't always lead to higher performance. Let's look at U.S. stocks, and we see the rotation once again. Best performer third quarter was large cap growth. Worst performer was small value. So small value went up here and large growth went down here. Not surprising. That's that rotation where the winners become the losers become the winners. That's just going to continue. That makes it very difficult to be momentum investors. I always like to say momentum works until it doesn't, and it rarely works for very, very long when you're investing, so be careful with that. Small value over long periods of time have underperformed. We don't see that in all markets across, all equity markets across the globe, but we have seen that in U.S. markets and international developed as well. Definitely a very strong quarter for all equity classes. And then other than these guys over here, everything else has looked just fantastic over the last year, 3 years, and 5 years. Not much to complain about. International developed, worst place to be was value. In fact, last quarter, value lost 2.05%. Hopefully you didn't get rid of it because this quarter in US dollars, the last quarter of 2020, it bounced back dramatically, 19.3%. So when we look at the longer trends for international developed, we see that value, like US equities, underperforming. The other ones look okay. look okay. And here's value just underperforming. But there's this idea that value may be coming back in a strong way. It has outperformed across the board this last quarter. So we'll keep an eye on that. Emerging markets, this is where that value story changes. Over the last 10 years, really the only bright spot has been value. Over the last 5 years, value outperforms. Over the last 3 years, value outperforms. Over the last year, value outperforms. And as you would expect, it underperformed and rotated in the last quarter. That's the same trend we saw. Instead of growth, it's value outperforming in international, developed, and U.S. And we see the opposite happening in emerging markets. Let's look at real estate. Here we separate international, and that's called World ex-US, from US REITs. And even though international REITs outperformed US over the last quarter, over the last 10 years, US has outperformed, although over the last 5 years, international REITs rather have outperformed. So real estate isn't that interesting story. It's hard to tell how things are going to shake out. We anticipate that there might be some structural changes related to the pandemic that will persist after the world starts normalizing, and that might be because more people start working from home. We'll just have to see. That could have an impact on the long-term a longer-term recovery for real estate. We'll continue to watch it, but we're not abandoning it in our portfolios. Fixed income, pretty easy story. When stocks are doing really, really well, you almost always know that high yield's going to perform well. High yield is kind of like a stock surrogate. Performs very well when stocks are performing well, and it loses value when stocks lose value. So you want to be careful. It is not a hedge against stocks in the way that these higher quality bonds are. But these higher quality bonds are not performing like high yield and like stocks. But if you have a balanced portfolio and you think that your high yield bonds are providing a stability, a hedge against the risk in stocks, unfortunately, you're not correct, and you're going to be surprised. And so be careful with that. And then lastly, this is the last slide. I just want to show that as we add stock to a portfolio, so we're starting with 100% T-bills. As we add more stock, we are increasing risk, and we're measuring risk by the standard deviation. So here's a standard deviation for 100% in T-bills. These are considered the safest assets on the planet. Here's the standard deviation for 100% in stock. So a much higher value there, and that means that there's a lot more risk. So we would hope that as we add more stock to our portfolio, the performance goes up, and it does over the last quarter of 2020. Overall at 2020, that also holds up. Over the last 3 years, bingo. And over the last 5 and 10 years, it usually almost always holds up, and that has perfect harmony. I always do this. You remember a couple of quarters last year, the quarterly in 1 year, and I think even 3 years in one of those quarters, did not hold up. It holds up across the board. And friends, you have now been updated with the fourth quarter and some longer term performance. There you go. In closing, thank you for your time and attention. I hope you learned something. Remember, we live in a very noisy world, so do your best to look past the headlines and control your emotions so that you can stay disciplined when it really counts through any market dips and swings we may experience. Resist the temptation to outguess the market or chase past performance, and focus on the long-term drivers of return and let markets work for you in an appropriately diversified portfolio for your needs and risk tolerance. Until next time, from all of us here at Mariaca Wealth Management, we extend our very best wishes to you and yours for a happy and healthy 2021. It has to get better, right? We'll see you again soon. In the meantime, please follow and like us on social media for the latest firm news and shared content.